Good afternoon, everyone, and welcome to Pioneering Pensions. For you who don't know me, my name is Stefan Lundberg, and I have a passion for pensions. And today, we have the great opportunity to meet with David John, who has done a lot of policy work through the years in the United States. He's working for the Association of AARP, and he also in the Brookings Institute as a research lead. And David, you have done a lot of policy work, as I understand, over the years, both for Democrats and Republicans. So I wish you very welcome to Pioneering Pensions.
Thank you very much. Thanks for having me.
And before we get going, I just want to repeat how we typically do things. We're going to have a 30 minutes conversation, me and David. And while you're listening to that conversation, write down the questions you have for David, because this webinar is there for you. So you can ask your question to David, and he will answer them in his very clear way, as he always does. So David, the first question for you, there is a security legislation coming in the US. Can you give us a bit background where it is and what's going on?
Yes, this is called Secure 2.0, and Secure is actually an acronym. It is now popular in Congress to create some sort of a long title that you can abbreviate as a word. And this is the second time they've done that for this particular word, so it's Secure 2.0. This is a compilation of small retirement-related reforms. This is not a big reform like the automatic enrollment reform or anything like this. It includes pieces to make it easier for employers to offer annuities or other lifetime income products, to make it easier for individuals to find lost pension savings, and also to make it easier for employers to offer certain types of emergency savings products. At the moment, we're in what's called a lame duck session, which is the session that the Congress uses after an election to complete its business. Come January 3rd, there's a brand new Congress and everything starts over again. And typically what they will do at this point is to take everything that's outstanding, including most of the federal budget, and put that together in one huge long bill and pass it. We don't know at this point precisely what's going to be in the legislation. There were 3 different bills that came out of different committees in the House and Senate, and those have to be reconciled and agreed to. One that was very interesting was one that would have allowed automatic enrollment, or actually required automatic enrollment in all new retirement plans, but we don't know if that's going to come about yet. So this will probably appear and be voted on sometime in the next 10 days to 2 weeks, and at that point we'll find out exactly what's in it.
Sounds like an exciting period.
Very
You
much.
mentioned that auto enrollment, and in the UK they included that to get advocacy across the whole population when it comes to pensions. Do you think it's a chance that that will be implemented in the US?
Oh, yeah, it's just going to be a matter of when. We have auto enrollment reforms in so far 14 states of different types. Most of it uses something called the automatic IRA, which actually is stands for Individual Retirement Arrangement. And we are seeing very strong success in those programs. The Auto IRA is a very simple, easy to understand retirement system typically for small businesses and their employees. But the odds on a federal reform for the foreseeable future are actually fairly dim. We don't expect that Congress is going to agree, especially one that's as sharply split, because it's very controversial in the US to require an employer to do something or other, offer a particular benefit. That's something you've overcome in the UK, and hopefully we will too at some point.
Well, it's positive to hear that at least in some states they're making progress in this direction. You also mentioned additional savings vehicles. I think in the UK we have something we call it sidecar, and in a previous episode of Pioneering Pension, Will from Nest Insight Zone. What are your experiences in the US with these sort of additional savings vehicles?
Well, one of the things, actually, we are watching very closely the Nest experiments there. We have some that are going on. The thing that we have discovered is that the enrollment method is very crucial. If you can auto-enroll, which is what Nest did in one of their experiments, you get actually a fairly decent participation rate. If you don't do that, typically people will say, yes, I'm very interested in this benefit, but they don't actually enroll in it. US law does not allow auto enrollment except perhaps in something called a payroll card, which is sort of like an ATM card where your money can be deposited and you can access it that way. That will partly change with luck if one of the provisions of the Secure 2.0 goes through. One of the things that we are learning is that there is actually a huge value to having and using emergency savings. We at AARP commissioned a paper a couple of years ago from two noted academics, and they found that having and using emergency savings actually had a very substantial impact on the household stability, the financial stability for several years going forward. And if this continues to hold, we had some data issues, so we couldn't do it for as long a period as we liked. We think that this means that a more stable family finances means that people will be able to save more for retirement in the future, but also that the general future of the family finances will be stronger throughout life than if they didn't have these emergency savings.
And when you looked at this, you looked at the kind of category of people who doesn't have a lot of savings in the first place.
Yes, absolutely. This is actually true both with our auto enrollment reform, the auto IRA, and with emergency savings. We find with emergency savings that actually people lack those up and down the income scale, but it's obviously more of an issue for lower incomes. And one of the things that we discovered was that many times advisors would talk and say, well, what you need is 3 to 6 months expenses in your emergency savings, which for an average individual person is completely ridiculous. And we find that it actually discourages people from savings. The experiment we did, the paper we had done, actually had closer to 4 weeks or a month of emergency savings. And that seemed to be the optimal amount for at least most people.
That's very interesting, David. And I'm also wondering, there was another thing you mentioned around small pot consolidation. And this is a big discussion in the UK and I think many other places because everybody has multiple jobs, so you end up saving money and it ends up in pots everywhere. So could you tell us a bit what's going on in the US and how US is addressing this problem, but also how big or how small is a small pot?
Oh, that's actually an excellent question. I mean, the bottom line is Steve Webb was right years ago with pot follows member. That actually is a very significant reform that we are now looking at. And we are finding actually that the problem is that when you have to start over, when your money has been sent to you or it's been sent to some unknown location, that especially affects people of color, women, lower income individuals, in other words, the people who need it the most. The small pot is defined in two different ways. If you have aggregate savings when you leave your employer, and keeping in mind that in the US, the median time that an individual is with one employer is about 5 years. So over the course of your career, you're going to have a number of these if you don't start to consolidate them. But if you have less than $1,000, the employer is allowed basically to hand you a check and say, here's your money, go do something with it. And of course, because this is a tax preferenced item, that means you have to pay taxes on it and probably a penalty too. If you are between $1,000 and $5,000, and that number was chosen quite some time ago, then they can basically either keep that money in the plan, and then you can move it at some later date if you can figure out how, and or they can send it to something called a rollover IRA. And the problem with a rollover IRA is, first and foremost, that the fees are going to be much higher. The investment options are going to be much worse. And these are typically ones that get lost. We have data showing that for rollover IRAs, the number that, or basically are 10 times less likely to be claimed by age 72 than any other type of retirement pot. So typically these are lost.
So how do consolidation work in practice? Is there some private initiatives, or do you expect you need legislation for making it happen?
Well, this is actually a really fascinating situation right now. We have a private sector combination of the three largest record keepers in the US, and many more are looking into joining, with something called Retirement Clearinghouse, which has developed software and the like to automatically move retirement money from employer to employer. We think that this is going to start being in operation sometime in January. That's when the largest of the record keepers says that they'll be ready. And if that's the case, when you leave an employer, this is if you have a pot that's, say, $5,000 or less, you will get a notification from the consortium essentially saying, look, we're going to consolidate your money if you don't tell us not to. I mean, you have the option to keep it where you want. But as of X date, it's going to move from your former employer to your new employer without you having to do something. And this is fantastic. We are also hoping that we will see at some point soon a lost and found that allows people to track their former retirement savings programs. But this is not a problem that just deals with $5,000 and under. That's being dealt with slowly but surely. I mean, as one who moved jobs about 10 years ago and did have substantially more than $5,000 in my savings, I can say that the only reason, because of legal questions and operational questions and things like that, that I managed to consolidate my retirement saving was that I had an advisor who knew exactly what to do and what forms to submit and the like. Other people, including those who actually have dealt with this issue for decades and had high federal positions, are still trying to figure it out. It's a mess, really. Excuse me.
So this lost and found then will sort of make it easier to do the transition as well, if you want to. Is
Yes.
that kind of a consequence of it?
Yes, exactly. I mean, it's a little bit similar to what you're doing with dashboards at this point. But the one thing that we have to remember is that unlike auto portability for the 5,000 and less, this means that you're going to have the initiative to go find your money. It's not going to find you otherwise. And in many cases, we have people who have absolutely no idea that they had retirement savings from 20 years ago or something like that. And the provider has changed names and merged, and the company may not even exist anymore. So we still think that this is just one step along the way to a consolidated pot.
When you look at it, you can say it's kind of amazing that private providers come up with the idea of sort of moving the money from one to another. What is the driver behind this? How did it so come to be?
You know, the driver is a couple of different things. One is equity, because we have a substantial racial wealth gap in the United States and probably elsewhere. And this is one way that we can start to reduce that gap. And as a result, many of the advocacy organizations for people of color and other groups are very actively involved with this. The other reason actually is that we are discovering if somebody is going to have sufficient retirement savings to actually have a comfortable retirement, that needs to be accessible and it needs to be to build up over time. Losing and consolidating or having a number of different pots is actually very much a problem going forward. And last but not least, we have a tax system called required minimum distributions, which basically is designed to make sure that people aren't using retirement accounts as a way of avoiding taxes. So as of age 72, you must start to draw down your retirement pot. So if you have one pot, it's an awful lot easier to manage than if you have 10 or 12, because the required RMD applies to all of them.
Very good. And then the providers they do this because it's a lot of work for them as well to deal with the smaller pots, right?
It is. I mean, typically the $5,000 level was chosen a number of years ago, and that supposedly was the one where you would, if you were a provider and a record keeper, you would start to break even. The reality is that that's now much higher, and there actually was a provision in one of the earlier forms of the secure legislation that would raise that to 7,500. Essentially, providers are discovering if they have larger amounts that this is actually much better for them.
Yeah. So it's actually driven by the industry, because if you do it this way, you can get a better profitability, basically.
Well, yes. And of course, there is one other factor in here, which is the American hobby of suing various and sundry people at the drop of a hat. So the Supreme Court changed the rules for fiduciary responsibility several years ago. And it is widely believed that in the long run, every record keeper and employer will have an auto portability function, simply because it will be required as a fiduciary matter.
Very good. And if we start looking at converting your savings into income and start looking at the retirement phase, because a lot of discussion is around the savings phase. I remember in the documentary that Theo Cocken made, it's called Your 100-Year Life, you have some key openings there. And one of them I really like, where you're saying, sitting on a beach, sipping pina coladas is no longer realistic. Can you elaborate what you were meaning with that?
Yeah, sure. Absolutely. And the funny thing is that I think that was recorded shortly after I had been on vacation in Florida, sitting on a beach, sipping pina coladas, but, or probably margaritas, actually, in our case. Essentially, retirement is shifting rather radically, and this has to do with the increase in longevity, but also a variety of other things. Typically now we are seeing much more interest in working longer than in the past, in having a transition type of job, whether that's moving into something like consulting or fewer hours or something along that line. But even more than that, we did a study of Americans who had retired, and excuse me, it's dry in here. And what we found was that a significant number of them were going back to work simply because they said, I rested for a couple of weeks and I cleaned up around the house, and frankly, I was getting bored. It was time to do something else. Inflation is adding a fair amount to that toll also. But even now with inflation, when we asked people why they were going back to work, only about half of them said it was for financial reasons. The rest of them went back to work for a social network. They didn't want to sit around the house alone, or to have a feeling of worth or something along that line. So it looks like in the future, retirement is going to be much more a matter of dipping in and out of the workforce as you get older, or basically having something to do other than sitting on a beach with a pina colada or something along that line.
So I'm thinking like the gig workers who are young, zipping in and out of different jobs. The old people, retired people, are going to do more or less what the young people do. So the people in the middle, they're going to be working full time, but the young and the older are going to have a more flexible approach.
I think that's true. And one of the things that we are seeing increasingly is the number of older people who retire and then start their own business. And that might be something that is connected to their former career. But in a lot of cases, it's something that they found interesting, but they just never got around to doing. So it might be a hobby or something along that line. And it looks like this is going to be necessary for a number of people, unfortunately, because they may or may not have sufficient retirement savings going forward.
Yeah, I say, if you do it because you love it, it's a great thing. And if you do it because you have to, well, it's not so great. But on the other hand, if you don't have any alternative, it's good anyway. I was wondering, in the US, what kind of products are people selling to help people sort of do the transition from saving to income?
Oh, this is a really interesting time because we're starting to see some definite changes in the market. Initially, everybody had the idea that you were going to have a single premium annuity, the one that you pay X dollars for when you retire, and this is going to provide additional income along with your Social Security. But that's changing now. Now we are seeing more managed payout strategies where your money remains invested and the amount that you have may change from year to year, the amount that is sent to you, say, on a monthly basis, because that's typically the way Americans do finances. It is changing perhaps moderately. We're seeing something called longevity annuities, which basically says I will pay a small amount now at, say, age 65 and start to draw down at age 80. And this protects me if I happen to live much longer than I expect, which is typical. We do have a significant number of traditional providers, insurance companies in the US, who do push annuities and are thoroughly convinced that the market really wants the old level of annuities. But the resurgence of inflation is kind of changing that picture a little bit. Because although most consumers don't understand necessarily the longer term effects of even moderate inflation on a fixed amount of pension income, we know that the litigation attorneys very definitely do, and that this may be something that starts to happen in the future.
We have this annuity puzzle. People
Yes.
kind of tend to want an inflation-linked annuity, but no one really would like to buy one. And I remember you wrote a paper where you're trying to address that. Can you explain that and also tell us if someone picked it up, a provider?
Yeah, now this is a really interesting situation. And I have a little bit of experience on my own part because our younger daughter is in college. There is actually a psychological value to having what looks like more money than you've ever had before in your life. And converting, say, $100,000, which is an awful lot of money for most people, into an income stream that's roughly $550, $575 a month, seems like I'm taking something that's a major asset and converting it into pennies. There is a real problem with that kind of drawdown. So my colleagues at Brookings and I proposed a paper several years ago suggesting that when an individual retired, they would have a certain portion of their retirement savings rolled into a temporary annuity. And after a certain period of time, they could decide, do you want to continue this annuity or do you want to receive a lump sum and go forward? The idea is, again, to get over this wealth thought and to go forward. Now, one of the providers, TIAA, which typically deals with academics and the like, is instituting a 2-year trial annuity. This is something that is fairly new, but they are finding that it does have the kind of effect that we expected, that people are starting to understand this savings is meant for retirement income, for your secure retirement income going forward. It's really not there to look at or anything along that line.
So it will be really interesting to see how that experiment going to work, if people are going to stay in or if they're going to back out. So looking forward to see that. In the previous conversation, we talked to Bonnie Jean McDonald, and she has a question for you. And instead of me repeating the question, let's roll a tape and hear what she has to say.
So David John, he's a very respected thinker in the space, and I would be interested to know if he sees dynamic pensions taking hold in the US the same way that they have been evolving successfully in Canada to fill our decumulation gap.
That's a really good question, and it goes into the next level of retirement income there. What she's talking about, a dynamic pension in Canada, is somewhat similar to a tontine, where you have most people going into an invested pot to pool longevity and pool investment risk, and you receive a certain payout that can be adjusted based on the performance of the investments. We are seeing that in the US. We actually, at Brookings, wrote a paper on something similar, a managed payout fund, and also on tontines. Technically, a tontine right now is illegal in the US because the insurance companies wildly mismanaged a similar system in the early 1900s that disadvantaged a lot of people, so they were banned in New York State, which is the lead essentially in financial legislation. But that's changing. We actually have a type of what she's talking about, the dynamic pension, that is being developed in the US. And I'm actually talking to the CEO of that on Monday. So I think, yes, what the kind of work she has done and the kind of advances that are starting to show up in Canada are definitely going to go across the border and be seen in the US in the not too distant future.
That sounds very promising. And I think we need new solutions for the payout phase. And I think there's a lot of discussion also in the UK if you can do collective DC in the payout phase, or which is hopefully, if it's designed in a good way, will look pretty much like the solution Bonnie Jean is explaining. Yes. And there's also other ways to do it, to put sort of an overlay on top of a fund, which is also done in Canada, to longevity overlay. But before we open up the floor to questions, I have another final question for you here, and that is, we're all thinking about how can we make better solution? How can we make pension work better for people? And then, of course, once you have a decent solution, the big problem is implementation. Yes. So since you've been in this game for quite a while and seen many different aspects of it, what do you think is sort of the most important thing to do to get something from, a good idea into something that actually is something people can buy?
I think the best thing actually is not to throw away a past system necessarily, but to build on what you have and to improve that. Confidence in a system is a very fragile thing, as I think the UK discovered about 20 years ago with SERPs and the like. And building that confidence back is very difficult. So what we did, for instance, with the auto IRA for in the States, is to develop something that used existing products and existing programs and repurpose them in a different way. It needs to be something more than anything else that's simple. If you have to train somebody to use your product properly, frankly, you failed in the mass marketplace. That probably works for sophisticated investors and things like that. But when you're talking about hourly workers or even 95% of the salaried workforce, that's not going to be a solution in the slightest. So simplicity, more than anything else, is essential for the individual.
Yeah, and if you would kind of take that and see what we could be in the UK, I think you do have vehicles called master trusts, which are there,
Yes.
and they already exist. So if you can develop solutions that you can easily apply within the master trust, I think that's probably a good way to build good retirement solutions.
I think you're right. And what we're starting to see, for instance, is retirement income solutions that are starting to be folded into the savings mechanism. And so that rather than a huge transition from one product to another, to having to make complicated decisions using terminology that most people don't understand anyway, is taken away, that you're moved into a product. And then if it doesn't work for you, it's flexible enough so that you can move into something else that better meets your needs.
I fully agree with you, David, because there's so much nonsense. So if someone could make a no-nonsense product, that would be great. Yeah. I have a question from Aska here. So one of our participants, he says, do you have a feel if these systems changes will be more beneficial than Nest in the UK? And he's referring back to the bill we were talking about. So the changes coming in the US, will they have a better impact or be even more beneficial than Nest in the UK?
Not necessarily, because the US market is very heavily fragmented. We have literally thousands of providers of different types. I mean, we obviously have a lot of concentration at the top, but Nest simplicity is something that, frankly, is very similar to what we're seeing in the state programs. We still have a very long way to go before we have one fairly simple, easy to understand and operate retirement system. The UK has actually gone ahead of us in certain aspects with the auto enrollment. That's a good question, though. Yeah.
We have another question here from Henry. He says, in the US, a small pot is less than $5,000. And then the comment is, in the UK, a small pot is less than £100. And he asked the question, is US more realistic or UK more caring? I don't know what you mean by caring there, but...
yeah, I'm not sure about caring either. The bottom line is that the pot size was chosen essentially for economic reasons more than anything else. And keep in mind, this is 5,000 and less, and it's not only 5,000 and above. So the auto portability will apply to any pot that at the end of an individual's employment is $5,000 or less. And that includes any roll-ins once the system is operational from previous jobs.
Okay, so once someone has been working for a while, you're probably going to have a pot which is a bit larger than 5,000 then. So it's not going to be that much turnover.
Yeah, I mean, we are finding, for instance, in the state programs, which are primarily serving hourly workers at small businesses, that at the moment the aggregates or the median size is about $1,000, and that's achieved after several years of savings by the individual. So it's something that is more consequential for a worker with lower amounts of income, because the typical contribution level in the state programs is about 5.3% of gross pay.
Okay. So actually now auto enrollment in the UK is 8%, so that's a bit better actually.
Yes, it is. And you have a match. This is 5% of the individual's paycheck there is no employer match that's allowed. And that's because the vehicle that we're using, the IRA, is defined as personal savings. So we are hoping to change that over time.
We have a question from Robert. How do programs such as Oregon Saves fit into these changes? And I think he's referring back to the proposal as well, or the bill.
Yes, well, Oregon Saves is a very interesting one. Oregon Saves was the first auto IRA program. We currently have 5 states that are in operation: Oregon, California, Illinois, Connecticut, and Maryland. And we have others that are 9 others that are coming online. They're in the process of implementing this. Essentially, they are operating to some extent as a starter account. The law says in those 5 states that a small employer must either join the state auto IRA, in this case Oregon Saves, or start a private sector 401k or similar program. We're finding actually evidence now that a substantial minority of employers decide, well, rather than going through the state program, I'm going to start something through one of the providers, the private sector providers instead. So when an individual moves from employer to employer, if the new employer is in the Oregon Saves program also, they keep the same amount. So this actually solves a portability issue there. If they don't, then we are hoping that one of the changes in the Secure Act will allow them to move that money into a 401k, and then out of the 401k back to Oregon Saves if they go to an employer there. The goal is, this is the most simple, low-cost solution for both employers and employees.
Yeah, I think that's important, and particularly what we see in most countries is make it easier for the employer to actually enroll is really important, to enroll their employees.
That's true.
We have a question from Bernard here. It says, in the UK, it seems as if there has been an increase in people cashing out pensions at the minimum age, which is 55, even while they're still working. This seems to have happened in a few quarters as a result of high inflation. This has longer-term pension consequences. And the question is, what is the US experience as a consequence of the cost of living crisis? And he says, under CARES, it could be done during the COVID crisis. What do you think are the long-term implications of it?
Well, that's a really good question. Just FYI, CARES is another one of those wonderful pieces of legislation where they created a title that spelled a word. So this was the legislation that provided support for people who were affected by losing a job due to COVID or other problems due to COVID. And one of the provisions did allow for penalty-free withdrawals from a 401k in order to meet that kind of expense. Interestingly enough, we saw a large number of polls and surveys that said, oh yes, I stopped saving, or I pulled money out of my savings, etc. And the actual experience when you talk to record keepers and the state programs was actually somewhat different. And what we think is that in the polling, many people don't really differentiate between pension savings and other types of savings. So if they pulled something out of a passbook savings account, they answered yes. We are seeing some withdrawals now due to inflation. We are starting to see some people who are reducing or ending their retirement savings due to inflation. And yes, this is incredibly serious because, of course, having a long tenure in your retirement savings is essential to building up a substantial amount going forward. We also know, however, that people have a present bias, and doing something like paying the rent right now is far more important than necessarily thinking about something that might happen 30 years in the future. So yes, we are seeing this. The long-term implications are bad, but we are also seeing that when we have emergency savings, that ameliorates that problem to a slight extent. Unfortunately, emergency savings are not very widely available as a benefit at this point.
And also, David, some people say that, well, if the alternative is to take some of your pension money or take some credit card debt, it might actually be better for people to not take the credit card debt.
Oh, yes, absolutely, completely. That it is much better for that. And the 401k may have a feature, depending on the employer's preferences, where you can actually borrow from the 401k and then repay the money over time at a fairly nominal interest rate, which at least rebuilds your retirement savings. In the state programs during the COVID problems, we saw a number of people who pulled money out, but they continued to save. They continued the payroll deduction, and that helped to rebuild their savings over time. So the key question is to make sure that a temporary problem doesn't become a permanent situation.
I like the idea of borrowing money from your pension, because if you have a reasonably high contribution rate and you can borrow money, that's the same as having a lower contribution rate and having a sidecar, isn't it?
Yep, absolutely. Yeah. Yes. Yeah.
There's another question here from Bernard. He says, of course, all of this is relevant to sidecars. To what extent might pension funds become provident funds? And what do we know about the Singapore experience? People don't have much left by the time they get to retirement, ?
Yeah, no, that's a really interesting question. I mean, one of the things that we're discovering in the US, and I think this is pretty much universal when it comes down to it, is that savings is a continuum, that it is a mistake to an extent to silo savings for different purposes, because life events change, priorities change, and things along that line. So in addition to a retirement program, one actually needs another type of savings that may or may not be tax preferenced, may or may not have an employer contribution or match or something along that line, but something that needs to be much more flexible so that you can, as life changes, which it does, you can move from priority to priority. So we are seeing that. We are seeing some interest in that. We are seeing some employers start to explore this kind of purpose. So for instance, in the US, student loans are a very big deal for many people. And we are seeing employers that are saying, if you pay a certain amount of income to your student loans, we will treat that as though you had made contributions to the 401k program, and we will match that in the 401k so that you can both pay down your loans today and have more security for the future. The Singapore experience is rather unique. We just had some discussions about Singapore at a conference I was at from the Aspen Foundation, Aspen Institute, excuse me. And the thing of it is, in Singapore, you end up with an apartment or housing that has been paid for in part by the Provident Fund, but then you basically draw that down through essentially a reverse mortgage type process, and that ends up paying for your retirement expenses. So that's something that fits that particular area. It's not necessarily something that we're going to see universally.
And it's pretty much up to the employer to offer this nice matching, paying off your student loan and getting something into your savings. Is this something like, it's a few sunshine examples, or is it something you see kind of broadly applied?
This is at the moment we're at the sunshine examples. The Treasury Department several years ago allowed a particular employer to do this, and other employers have followed suit, mostly larger employers. One of the provisions that we're hoping to see in the secure legislation is one that makes this a much more widespread practice. And then we'll come into the question in future years, well, if this works for student loans, should this also be allowed for various and sundry other types of important expenses, such as healthcare, because we don't have national healthcare, or various and sundry other types of financial issues that an individual has?
Yeah, I'm a bit worried about the healthcare because to a large extent, healthcare, particularly care later in life, is probably best to insure on a national level rather than an individual level. So I have this kind of hunch that the more you sort of push it to the individual, the less you're going to have available. And also you have to sort of self-insure a lot of stuff that you could insure across the whole population.
I agree very much. And we also have the issue of how do you manage this? Because in the US, our healthcare is largely handled through insurance, which may be Medicare, which is a federal type of health insurance for retirees. But trying to figure out the program and make sure that it's useful for your particular needs is something that can, it can take full-time involvement for a substantial period of time. We've done this way too much when it comes down to it. So much of the health system in the US, retirement and various and other things have been pushed on the individual, who is likely to be the least capable of making an immediate decision in their own benefit. This is something that, whether it's the concept of a combined group or combined type of retirement policy or payout policy or something like that, really needs to be explored much further.
Yeah, and I think it goes back to what you said before. If something is so complicated, you need to be trained to understand it. I think that goes for a lot of the stuff. We want to give so much flexibility to the individual that for the individual, it becomes really tedious to deal with it.
Yes.
And John has a question here for you. He says, will the US adopt a UK-style mandate to offer, so there's auto-enrollment for employers? And he says, you have the master trust, of which Nest is one, but you also have People's Pension Now and Smart and others, or the 401k/auto IRA.
This is sort of a painful subject for me because a colleague of mine and I developed the auto IRA about 16 years ago. And at the time, we had bipartisan support in both the House and the Senate. And we went into 2009 absolutely convinced that we were going to pass this on a national level, and it was going to be non-controversial. And at that point, Obama came up with health care. And somehow the idea of offering or requiring an employer to offer a benefit became incredibly controversial. And our Republican sponsors were defeated in the next election, and our Democratic sponsors continue to support the idea, but it is just way too controversial on a national level for the foreseeable future. Someday, yes. As Churchill supposedly said, Americans do the right thing after they've tried everything else first. And I think we have to try everything else first.
We have a question here from Robert. He says, in some countries, it seems the finance industry fight changes as it would impact their incomes. Is this also a US issue?
Oh, very much so. Absolutely. As a matter of fact, we actually had an interesting fight because one of the things that to try to get people to focus on the fact that they are saving for retirement income rather than for a lump sum is to put a provision in the quarterly statement that people receive showing how much income they would receive, both for their current savings and if they continue to save at the same rate. And that was universally regarded as a fantastic idea, et cetera, until the Department of Labor started to work on, well, how do we do this? And at that point, there was a huge fight between the insurance industry and the banking industry as to what formula would be used to produce this number, whether it would be an insurance annuity contract or one of the types of retirement income products that banks could offer customers and the like. And that pretty much stalled a great deal. So yes, we have a substantial number of both employers and providers who are much more concerned about what goes on over the next 90 days, because earnings in the US are reported quarterly, than they are with what makes a good policy going forward. So this is one of the reasons why we're discussing the whole idea of trying to do incremental change rather than a wholesale change of the system. I'm afraid that politics is always there.
Well, it is there and it will always be there. And sometimes it's good that it takes time to make decisions, because then they don't change too much at the same time.
You know, one of the keys is to make sure that there is enough flexibility in legislation and regulation. Because, for instance, we are seeing a great deal of new ideas developing, especially in the retirement income space right now. So we don't want to lock in a reform that basically turns out to be counterproductive in future years.
That's a good point. I know a couple of entrepreneurs who are trying to do something, and it's really difficult to get the commercial momentum. And also, if you have to go fight policy at the same time, it's going to be really difficult. But there was one thing that I've been wondering about when we talk about transforming savings into income, and that is, we typically think like, in the old days, we had defined benefit, and that turned into an income, and we pay, say, 30% of our salary into a DB scheme. That's kind of the price of it. Everybody realized that's way too expensive, so now we pay 8% into our DC scheme. But is our dream about lifelong income actually wrong? Are we looking at the problem from the wrong lens? If you end up with $150,000 at retirement, should you do other things than kind of go for a lifelong income? Perhaps thinking about, how do I want to spend my money for the next 15, 20 years? And then after that, I actually have to live on social or the state pension alone.
You know, that's a really interesting question. And that actually applies to what Bonnie Jean was talking about in the dynamic pensions there. The theory that one of the problems with a tontine-like product is that your benefits go up as you get older. And however, we know that the typical spending pattern actually is the reverse, that the older you get, depending on healthcare expenses, the less you go out, the less you spend on entertainment and various and sundry other things. So you actually need a higher income level at retirement rather than, say, 20 years later. So this is one of the discussions going forward with the various retirement income products. We want to make sure that it actually meets people's needs going forward, as opposed to some preconceived idea that may or may not apply. So yes, I think this is a very definite and very interesting question. The whole question of the deferred annuity was designed to meet this need, where essentially, if you retired hypothetically at 65 or 67, and this deferred annuity kicks in at 80, you have a certain period of time that you need to manage your assets and to deal with there. And then once you reach a certain age, everything is taken care of because of the annuity. The deferred annuity has been wildly unpopular, and inflation, mainly because people don't understand it and they don't think they're going to live that long. but also inflation has changed the value. So over 15 years, even a moderate amount of inflation is going to change the spending value that you have.
Yeah, and if you look at it in real terms, it goes very expensive very quickly. So, David, now you have been answering our questions. So now is the time for you to ask a question, and that's going to be to our next speaker is Amlan Roy. He will come on January 12 next year, and he's got on a lot of thinking around demographic and how that impacts us. So, David, what's your question to Amlan?
No, he's great, actually. I would actually ask him that because of demographic changes and market situations, higher fluctuation, inflation, and the like, are we facing a situation where, like we had in the 1970s, where we had stagflation, where we actually had a negative rate of return over the decade in equities and high inflation on top of that? It'd be very interesting. I'll have to tune in to see his answer.
Thank you, David. It's been a pleasure to have you here for this episode of Pioneering Pension. And I would also like to thank everyone in the audience for bringing your questions to David. And I'm all looking forward to see all of you next time when we have a discussion with Amlan, including you, David. But I want to say one more time, thank you, David, for coming and sharing your knowledge with us.
Thanks for having me. It's been a great fun.